We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. As I always say to kick off the program every week, you can always go to the website to learn more, deckerretirementplanning.com, deckerretirementplanning.com. But I always say that as well because you go there, there's like 12 different things you can download, including Brian's book, the Decker Approach book, as one of the 12 things you can download. And it's really information for you. There's no cost to you. It's just there for your information. You want to learn more about retirement, got some questions, go to the website, learn more, deckerretirementplanning.com under the heading of Safer Retirement Education. If you have questions, concerns, boy, I wonder if we've got enough to retire. I wonder if we're going to be okay if we retire. I wonder if our money's going to last as long as we need it. Give the team a call. There's no cost. 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. All right, Brian, you and Arrin are going to talk a lot about some of the old, maybe not that old when you get to COVID, but you're going to talk about some of the market downturns because we're kind of in that area where things have been going really well in the markets for most of the year. Then we got a little bumpy early August, and now we're getting closer to the election. We're expecting more volatility. You and Arrin are going to discuss the fact that, hey, the markets go up, they go down, they go sideways, and it's really about how you're set up, how you're diversified, I suppose, in your portfolio.
Yeah, we want listeners, Mark, to go through kind of a litmus test so they can see what to expect from their plan and the markets. If we have a bumpy road ahead, there's a couple of reasons we expect a bumpy road ahead. One is we've had inverted yield curves for 29 months now. 29 months. Now, inverted yield curves are when short-term rates are higher than intermediate and long-term rates. That's been going on now for 29 months. The Fed's expected to lower rates, and Chairman Powell said he basically will in the next month. In the last 100 years of Fed policy history, it's hit and miss with inverted yield curves, but it's 100% when you look at inverted yield curve, you take the months that it's been inverted, that signifies or at least gives you a hint of how far down the market's going to go. And then you start the clock at the first Fed rate cut. Within 9 to 12 months after the first Fed rate cut, you have, by definition, two negative GDP back-to-back months, two negative readings of economic GDP. And that, by definition, is a recession. So that's been 100%. Well, we've had 29 months. And by the way, in 2008, we had 22 months, and that was a 50% drop. But that was kind of a special situation. I think that was an outlier economically. We call that a black swan event, a Six Sigma event, different names for it. But let's throw that out there. It should be a typical recession is about a 30% drop in rates. Now, we want to point out that in your 20s, 30s, 40s, and 50s, markets drop 30, 40, 50%. No big deal because you have your income coming from work and you have time on your side. You have the 3 to 5 years for the markets to recover. No big deal. In fact, you actually benefit because every 2 weeks you're kicking new money into your 401k. You actually benefit when the markets recover. Once you retire, and you're drawing income for your golden years of retirement from the account that drops 3 to 5 years, now that's a game changer. Now the account that's generating income and is producing income on a monthly basis is down 20, 30, 40%. And you're taking income. You're not adding to it. You're taking income. By definition, we're a math-based firm at Decker Retirement. By definition, when you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down, And that at some point becomes terminal. You will have to go to a plan B. You'll have to sell your home, move in with the kids, go back to work, some kind of a plan B, because it will destroy your retirement. That happened, in fact, in 2001, 02. Well, actually, let's get into it. There's a couple of reasons we expect some tough sledding ahead. One is what we talked about, and that is we've had an inverted yield curve for 29 months. The inverted yield curve that we had before 2008 was 22 months. We expect a recession coming up in 9 to 12 months. Second data point that says that there's tough sledding ahead is in 100-year history, the S&P 500 has only traded above a market valuation of 30 times trailing earnings. That's only happened 4 times. One was 1929, and markets were flat for 17 years. Took 17 years to get your money back. Second time was 1964, markets were flat for 18 years. Third time was 1999, markets were flat for 14 years. Fourth time was November of 2021, we hit 32 times trailing earnings. If history repeats, and history has been 100% on this, we're looking at the next 10 to 15 years where markets trade flat. Any passive investment strategy, buying and holding stocks, indexes, mutual funds, ETFs will yield a zero return with 100% history backing it. So what do? That's devastating to go 10 to 15 years with zero returns when you're in retirement. So let's take us through the last bubbles that burst, what caused it, what was the background, and how did the plans work? So Arrin, I'm going to put you in the hot seat. In 2000, 01, and 02, that was the tech bubble. Forget about interest rates, had nothing to do with interest rates, in my opinion, had everything to do with anything that was .com went to the moon. I remember the guy who headed Cisco and Broadcom. Those guys came out and said publicly they wouldn't buy their stock. The guy that was head of Broadcom, he said that his stock was trading at 37 times sales. 37 times sales. Those kinds of valuations are here now, and we're talking about it now because AI is kind of similar to the tech bubble. We'll see who sorts out winners and losers. The markets will do that efficiently, but there'll be some stocks that tank, some stocks that will be surviving and be huge winners. But in 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%, and during that 3-year period, people in retirement were drawing income from their plans, and that was devastating. So, Arrin, for our listeners, tell about how our plan would have handled 2000, 01, and 02, particularly buckets 1, 2, 3, 4, and 5. How would they have done in the tech bubble?
Mm-hmm. Yep. So this is one of the fundamental principles of how we put our plans together, is designed to provide protection in circumstances exactly like this, where obviously it's been a minute since we've had 3 years in a row of losses where 2001 and 02 were, but that doesn't mean that that won't happen again in the future. And especially for the people that were unlucky enough to retire in late 1999 or early 2000, when you're getting hit with double-digit losses, the S&P was down about 40% for those 3 years, NASDAQ down about 70% for those 3 years. If you have the majority of your portfolio in a stock-based strategy and you're taking income from it in a time period like that, you're in trouble. So the way that we set up our plans with our principal guaranteed accounts, depending upon the plan, they're going to be maybe 60, 65% of the total assets are held in those principal protected asset classes. Meaning, when those time periods happen, the 2001 and 02, and the rest of your friends or family members are taking massive hits on 80, 90, 100% of their portfolio, you have about 60, 65% of your portfolio that didn't lose anything. And in a lot of circumstances, actually made money. And so that provides a lot of protection for the funds that you're taking from income. And where you don't have the traditional 60-40 or 70-30 portfolio, you're also not going to have to spend the next 7, 8, 10 years trying to dig yourself out of that hole, cutting back your income. With the principal guaranteed accounts that we have, their job is not only to protect the funds that you have, but also to be able to provide you with a stable level of income over time. So a lot of times what people will do is when they have a bad year or the market has a drawdown, they'll cut back their income for a period of time to try to offset that. Where, I mean, yeah, you can technically do that, but who really wants to, right? Who wants to have to spend less, especially during the early years of retirement when you're trying to travel or go do the things on your bucket list, spend time with your grandkids, do your hobbies. Nobody wants to cut back on those things if there's a big market correction. So those principal guaranteed accounts, the buckets 1 through 5 that we put into place, really help not only prevent and protect against losses, but also help provide you with a stable rate of income during that difficult market period.
And I would say that there's 4 key things that we focus on with retirement planning on the laddered principal guaranteed accounts. Bucket 1 is money market. Right now, we're using Fidelity money market at 5%. Clients love it. Second, we have a 3-year CD for bucket 2, 5-year CD for bucket 3, 7 and 10-year equity indexed accounts. The first 3 accounts make money whether the markets go up or down. The money market's going to pay. CDs are going to pay. Yep. Doesn't matter what markets do. So you have tremendous peace of mind to go through 2000, 01, 02, 08, 2015, 2018, and 2022. Those were all rough years for the markets. And those accounts paid all the way through. Second, so first off is you have peace of mind. Second, we're using compound interest to our advantage when it comes to laddered principal guaranteed accounts. We're drawing from the lowest earning account, allowing the higher earning accounts to grow and compound. And what we have behind is we have the risk accounts growing for 15 to 20 years to replace what clients have spent. So our clients are enjoying very high, nice payouts. They're getting, well, let me just break for a second and ask you, Arrin, how much of the time, what percentage of the time do you sit in front of clients and you give them the first draft of their plan and they say, oh my gosh, that's much higher than I thought?
Yeah, that's actually one of my favorite meetings because of exactly that, where it's probably, I don't know, 80%, 90% of the people. Every once in a while, I'll have somebody that expected a little bit higher, but almost, I'd say 8 or 9 times out of 10, it's better than what they originally expected.
Yeah. And that's because of compound interest. So point number 2 on this 4 points of why we use laddered principal guaranteed accounts. The second point is we're using compound interest to our advantage that allows us a much higher payout for clients in retirement. The third reason has to do with during the 15, 20 years that we're drawing down the income from the principal guaranteed accounts, we have 15 to 20 years for the risk bucket to grow and compound more than offsetting what they even started with. So we have a replacement bucket to reload those principal guaranteed accounts. And then number 4, we're very, very conservative with the header estimates so that clients, being human beings, we want to hear those words, you're ahead of schedule. So we put the bar low enough. Bucket 1, we have earning 1%, and it's earning 5 right now. Buckets 2 and 3 are showing on the header at 3 and 4% when they're getting, both of those are over 5. And buckets 4 and 5 are showing 4% and getting over twice that. So those accounts, we're purposely being very, very conservative. But those are the 4 key things that are important to laddered principal guaranteed accounts.
So if you like the sound of that, you like the 5 buckets that Brian and Arrin were talking about, where you have the principal protected accounts to go with your money that's in the market, and you'd like to learn more, how does that affect you? Does it make sense for you? Does it not? 833-707-3030 again is the number to chat with the team at Decker Retirement. No cost to you. 833-707-3030. So they're going to come back, Brian and Arrin. They're going to wrap up the dot-com bubble bursting and how that affected people. They're going to move into the great financial crisis, 07 to 09. They're going to talk about that. They're going to get to COVID as well today. We're really talking about the markets go the wrong direction for us. How do we survive that if we're retired? That's what Brian and Arrin are talking about today, right here on Safer Retirement Radio. Back with more right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. You can always learn more about Brian, Arrin, and the team, DeckerRetirementPlanning.com. You have questions. You're not really sure, am I on the right track? Are we on the right track? Can we retire? Are we going to be okay? It's 833-707-3030 is the number. No cost for this chat. There's no pressure, no obligation, no judgment either. 833-707-3030. I'm Mark Elliott. Glad you're with us. So Brian and Arrin are talking about what happens when the markets go the wrong direction and how does that affect your retirement. Right now, they're still talking about the 2000 tech bubble, if you will. They're going to get into the financial crisis of 07 to 09. They're going to touch on COVID as well and how all of that affects retirees and kind of really more importantly, how their clients have made it through those times. So Brian, you and Arrin were discussing the 5 buckets that are principal protected. I guess that's kind of where you're going to pick up.
Yes. And so those did well. Even in 2000, 01, and 02, we have accounts that specifically bucket 4 and 5, the 7 and 10-year accounts are principal guaranteed accounts that allocate to stocks, bonds, and commodities. So on a daily basis. So stocks, bonds, and commodities. In 2000, 01, and 02, stocks were hammered, but bonds and commodities did well, allowing for buckets 4 and 5, those principal guaranteed accounts, to do very well in those years. When I say very well, I mean double digits well for that period. But then let's go in the risk side. What made money in 2000, 01, and 02? Well, we take our fiduciary responsibility very seriously, and we're a math-based firm, so we've done our homework. What works best on the risk side? Well, biggest study ever done is in Jake O'Shaughnessy's book, What Works on Wall Street, page 367, Appendix A. Since 1950, the highest returning strategies have to do with 3 descriptions: pure momentum, relative strength, and sector rotation. So the way this works is every stock is assigned a relative strength score 0 to 100, and you own the top relative strength stocks until something better comes along, and then you rotate into it. It's pure momentum. It's based on relative strength scoring, and you rotate into higher ranked stocks, indexes, and sectors. So in 2000, 01, and 02, when the S&P was down 50%, the NASDAQ was down 70%, there were many sectors and stocks in the markets that never took those hits. For example, real estate, the REITs did very well, double digits all 3 years. Gold and silver did well. Energy, pharmaceutical, biotech, healthcare, all those stocks and sectors did very well in 2000, 01, and 02. Then the markets bottomed in March of 03, and what really took off for the next 4.5 years were small caps, emerging markets, technology, and semiconductors. I mean, triple digits in their blast off first 12 to 18 months. They really rocketed. And then you own those. And then rotating into 2008, you were stopped into cash because everything went down into 2008 with one exception, that was treasury bonds. Treasury bonds were up 22% in '08. So you had a cash portfolio in your risk bucket and you had treasury bonds. That's how momentum works, using relative strength and sector rotation. So just cleaning up 2000, '01, and '02, the plans that we use momentum and would have done well across the board. We would have been one of the few firms that, like 2022, our clients made money across in their whole portfolio. In 2000, '01, and '02, also we would have made money using the planning that we have now. So it's a good litmus test to take it through a tough period like 2000, '01, and '02 to flesh out how well the plan is done. Anything else, Arrin, that we should point out in the tech bubble before we go to 2008?
No, I think that's great. Having a split for principal guaranteed accounts for protection, momentum-based models to help still make money in the markets is a good mix.
Okay, good. All right. Well, let's look at 2008. Now, 2008, according to the movie The Big Short, the making mortgages available to anyone, having no app loans, just really got out of hand. The Community Reinvestment Act saying that it was unfair for anyone to not have a mortgage. That created a major problem for the mortgage market. There were a lot of mortgages that were issued that should never have been issued, but they were just following what came out of Congress and making everyone acceptable to a mortgage loan. And when the default started, it was a domino effect that really affected the system, not only in the banking side, but on the investment side. And it was a domino effect that really, really hurt the world financial system. So from October of '07 to March of '09, that 18-month period, the S&P was down 50%. So again, I ask you, Arrin, in 2008, during that 50% drop in that 18-month period, how did buckets 1, 2, 3, 4, and 5 do?
Great. They have every single one of those has principal guaranteed protection. So in any circumstance, any possible scenario, any market circumstance you can think of, the worst return that any of those accounts could get is a zero. So you're not going to be in the same boat as those that are losing 40, 50%, having to spend years waiting to recover from that. They all had that protection. And like you mentioned earlier, Brian, the buckets 1, 2, and 3, where a lot of times we use fixed rate products similar to CDs for those shorter time periods, actually made money when everybody else had double-digit losses. And where we put 60 to 70% of the assets there, that did a phenomenal job protecting clients against those big market movements down.
And how about the risk bucket?
And that's really where those momentum models come to shine again, where you mentioned earlier in the 2000, '01, and '02, the specific sectors that did well. In 2008, most of those asset classes were down. Stocks were down, bonds were down, commodities were down, but treasuries did pretty well in 2008. And so being able to rotate out of those equity and stock market based holdings into treasuries, cash, other things that are going to provide both safety and have a little bit of upward momentum in that time period really helped those clients not only miss out on the losses, but also actually make a little bit of money in that risk account.
Okay, now it's interesting. What's happening right now with momentum is we are moving. We still have the semiconductors. We still have NVIDIA. NVIDIA reports in 48 hours. So there's a feeling of trepidation that if what does NVIDIA have to really do to keep this momentum going? But what's interesting is the other momentum models have moved pretty much away from tech, with the exception of NVIDIA, with the exception of the SMH, which is the ETF for semiconductors. Everything else is basically consumer durables, consumer staples, energy, cloud storage companies, things like that. So it's kind of interesting to see the momentum models start to move away like they did in 2008. Now in 2015, there was a little drop. 2018, there was a drop. Let's talk about COVID next. COVID is another black swan event COVID is where we had a 32% drop in 5 weeks. That's never happened before. So when we come back, we're going to go into detail on this, but COVID was a black swan event. We've never seen a 32% drop in 5 weeks. But when COVID was announced and the policy of the United States was also announced that they were going to be shutting down entire markets, entire cities from standard. Well, the consumer is 2/3 of this economy. And when you tell the consumer he has to stay at home and wear a mask and not frequent and stay 6 feet apart, that really slowed the economy down. By definition, we did have 2 quarters of back-to-back GDP, but Treasury Secretary Yellen said that the definition of back-to-back GDP numbers being negative didn't apply that time. So we did really have a recession, but we really didn't. Yellen said that really didn't count. So we had the markets drop, we had the bear market, and then the comeback was phenomenal. The comeback in the markets were amazing. So we had a 32% drop and we had a huge increase to where the S&P closed up 17% that year.
So again, if you would like to have a conversation with the team at Decker Retirement about your situation, what happens if, hey, the markets are great. Okay, good. What if the markets are down? Do I have too much money at risk? I don't know. Find out. Call the team. 833-707-3030 is the number. No cost to you, 833-707-3030. Brian, Arrin, and the team might be able to help, might not be able to help. They don't know until you reach out. And then if they can help, do you want their help? It's really that simple. 833-707-3030. Back with more with Brian and Arrin right here on Safer Retirement Radio.
Do you need help assessing your risk tolerance or adjusting your portfolio to help reduce your fees? For help with income planning, set up an appointment with Brian Decker today. Call 833-707-3030. That's 833-707-3030.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, you can go to the website, deckerretirementplanning.com. Under the heading of Safer Retirement Education, there are 12 different things you can download, including Brian's book on retirement, The Decker Approach, the 3 Principles of Retirement book, Checklist Challenge, a Sample Income Plan. Those are just 4 of the 12 things you can download, and it's really there for your information. You want to learn more about different areas of retirement, check it out. Brian's book, The Decker Approach book, would be a great place to start, just to read about all the ways that the team at Decker Retirement and how they walk through their safer retirement process. It is 833-707-3030 if you just want to have a conversation, 833-707-3030. All right, you've gone dot-com bubble bursting. You did great financial crisis of 07-09. COVID 2020, that's a whole different animal, it seems.
Yes, a lot of volatility. S&P down 32% in 5 weeks. That's never happened before in the history of the S&P, followed by a big recovery. A lot of volatility during the COVID years. A lot of uncertainty. How long was this going to last? Or the vaccines work? I mean, there was a lot of uncertainty. In retirement, you don't need that. So, Arrin, how did the buckets do? Buckets 1, 2, 3, 4, and 5, which is the foundational part of the plan that where our clients draw their income. How did that do?
Very well. They were protected again in that circumstance, and it allowed them to be able to, with buckets 1, 2, and 3, still make some money during that time period. With buckets 4 and 5, they were protected from any losses there and were able to continue taking the income that they expected to take because, again, those accounts cannot lose money. So with those principal guaranteed accounts, it provided not only the monetary protection, but also the peace of mind protection that, Brian, you mentioned a second ago. There was a lot of unknowns, right? It was a virus we hadn't seen before. They were coming out with a vaccine. The markets were kind of trying to figure out what was going on. So was the rest of the world geopolitically. There's just a lot of anxiety and uncertainty at that point in time. And as much as we focus on the value monetary wise and financially, I also want to highlight the fact that these types of investment vehicles, the type of income planning that we do, also helps give our clients peace of mind and emotional stability, that you don't have to worry about, hey, my friend told me that they were down X percent, or hey, I don't know how my portfolio is going to perform in this circumstance. It allows you to be able to just relax, have the peace of mind. You know you're protected. You know you have the right investment vehicles in place to carry you through any circumstances like that. Now, I know that one was fairly short, just a few months before things started to recover. But in the future, when there's some longer ones, maybe it's a year, maybe it's 2 years, maybe it's 3+, and you will still be able to have that protection, that peace of mind, and the income that you're looking for to be able to enjoy those retirement years.
So let's go through what would happen if you had a pie chart. So if you had a pie chart in 2000, 01, and 02, and you're using the 4% rule to draw income from a fluctuating account, Arrin, take people through what actually happened in 2000, 01, 02 with a pie chart, and then the market recovery, 03 to 07, and then the big drop again. And why in the world did we see millions of people with gray hair show up in banks, fast food, Walmart? What was behind all that?
Yep. So one of the traditional methods people use for distribution, basically how they're going to pull money out of the portfolio, is that 4% rule that you mentioned, where basically the premise is you take 4% of whatever your total portfolio value is out per year as the spending income in retirement. Now, again, if you were one of the unlucky people that started in 2000 and took that 4% rule approach, you were in for a world of hurt just a few years down the road, because in 2000, 01, and 02, you're down about 40+% just from market losses. If you're also pulling a flat 4% per year out of your portfolio, that's an additional 12% over those 3 years, meaning you've lost more than half of your retirement portfolio in just the first 3 years of retirement. Not a great place to start. Now, there is the recovery from 03 through 07, but then in 08 with that 40% loss there.
Wait. You don't get all that recovery because you're drawing 4 for 5 years. You got 20% down even if the markets go up.
Yeah. So the saying, you compromise gains on the upside and you exacerbate losses on the downside, very specifically applies to that 4% rule, that when bad years, you're pulling more out, that then leads to a further decline in your portfolio. In the good years, when you have those positive returns in the market, pulling a flat percentage out also diminishes the gains on that portfolio. So you have that over the first 7 years there. And then 2008 with that 40% drop there, that was the point in time when a lot of people had to go back to work, sell their houses, move in with their kids, make some not so fun financial decisions at that point in time. And that is because they relied on a flat percentage withdrawal method, just hoping the market worked out in their favor. Now, where none of us knows what the market's going to do a year from now, 5 years from now, 10 years from now, we, with our clients, do not leave that up to chance where we're just flipping a coin and hoping that the market works out in our favor. We're never going to leave you exposed to risks or to dangers like that. So having that flat 4% or any percentage withdrawal rule is going to leave you with a couple problems of either you're hoping that the market's going to work out in your favor, or on the opposite side, you're pulling less income than you could. Like we have some people that have come in and they want to be ultra conservative. And so they're pulling 1% or 2% per year. And that means you're really not enjoying the hard work that you've put into building up those assets. You want to be able to protect it, but you also want to be able to spend it appropriately to enjoy all the hard work you put into building up those assets. So it's a fine line between both of those. And that's really what our principal guaranteed accounts and our income planning process really hones in on, to make sure that we're meeting both of those goals for our clients.
Now, the guy that invented the 4% rule, his name is William Bengen. What did he have to say about his rule after 2008?
That it doesn't work. It's in the research and in his explanation there, he basically said, hey, this approach doesn't work in a flat market cycle. You have to have the basic premise behind it is, because stocks on average return a 9% return and bonds on average return a 5 to 6% rate of return, that 4% rule, when you look at it on average, can work because it's below the growth rates of stocks and bonds. But we all know that the returns of stocks and the returns of bonds do not come as any consistent average year over year. You may have a positive 30% year or a negative 30% year, and it's not promised any year over year. And so when there are volatile market periods like 2000 to 2010, you get the short end of that stick, and that rationale doesn't apply anymore with those average growth rates. So he basically came out and said, hey, this doesn't work. When I put this out, it was, I think it was like the early 90s or something at that time period, and hadn't had a time period in the past that had caused problems like that. And so he basically renounced that and said, hey, this isn't going to work for you anymore. But even though that was 2009, 15 years ago, that 4% rule is still touted as one of the main ways to approach retirement distribution planning, which just drives me crazy.
And on the radio, we're doing a community service. We're still in baseball season. So strike 1, 2, and 3. Strike 1 is when any advisor tells you that a pie chart is a retirement plan. It is not. Modern portfolio theory doesn't even say that it is. It is a look and see on how diversified you are in your portfolio. That's it. Says nothing about how much income you can draw, which, by the way, I think they're linked. I'm going to connect the dots for people. The reason that the number one fear of people in the United States 60 and over is running out of money before you die. And I think the reason is because advisors ask people 60 and over to use the pie chart to figure out how much money you can draw. And like you said, the 4% rule does not work in a flat market cycle. Well, guess what? November of 2021, we hit 32 times trailing earnings, which means that we have officially started a flat market cycle. The next 10 to 15 years will be devastating for people using the 4% rule if history repeats, and history has always repeated when we've hit these valuation levels. Oh, but Arrin, what about the Monte Carlo simulation that says that you've got an 89% chance of doing great? Did the Monte Carlo simulation take into consideration 2000, 01, 02, 08, 2015, 2018, 2020, or 2022?
This is something where the way that the person running the simulation has a lot of subjectivity around how it's put together, but B, let's just say that they are like the best person ever. They know exactly what they're doing. They know how to run the simulation. They put in all of those things. Even then, usually I hear in between 89 and 92% chance of success. And the clients that I work with are not interested in having an 8 or a 10% chance that they're going to run out of money before they die. Nobody wants to say, hey, 9 times out of 10, you're going to be okay. But on that 10th time, you're probably going to have some problems. Like, you never want to leave yourself open to those types of chances, especially where there's another option. It's not like this is the only way to approach that. Not like this is your only hope for working through those retirement income amounts. We have a better way to do this that does not leave you open to an 8 or 10% chance that you're going to run out of money. It doesn't leave you open to those dangers of the big black swan events. It provides protection in multiple areas. And those Monte Carlo simulations just don't take all those variables into consideration. And they don't really give you the surety that you're going to be able to have the income that you want until you die. So Not that they're, I don't know. I just have to chuckle a little bit when I hear those, because they leave a lot to be desired when looking at how effective a real retirement plan can be.
Okay, now I said that it's baseball season, 3 strikes and you're out. So strike one is when a advisor tells you that a pie chart is a retirement plan. It's not. Strike two is when they tell you to put your safe money in bond funds. Well, here's some background on interest rate risk. Interest rate risk is how you lose money in bond funds when interest rates go higher. From 1940, when the 10-year treasury was at 2%, 1940 to 1980, 40 years of rising rates, where they peaked out around 15%, just under 15. Then for 40 years, nice, neat and tidy 40 years of declining interest rates until August of 2020, we hit 0.47 on the 10-year treasury. No thinking human being should have advised people to put their safe money in bond funds when the 10-year treasury is at 0.47%. You have very little upside, very tiny upside, and you have huge downside risk. And yet it continued. Banks and brokers continued to advise their clients to put money in bond funds, and interest rates have risen. The 10-year treasury went from 0.47 up to 5%. And people in the last 4 years have lost over 35% on, and they were told also that that is their safe money. There's 3 strikes. 3 strikes. Strike one is you have an advisor to tell you that your pie chart is a retirement plan when it's not. Strike two is when you're told to put your safe money in bond funds. Strike three is when your advisor tells you on your stock portfolio to buy and hold and ride it out. Well, many problems in that. One we've already talked about on the radio show already and several times, and that is that we've entered a flat market cycle. We believe history has shown when you hit a valuation level of over 30 times trailing earnings, the next 10 to 15 years are flat. So if your advisor tells you to buy and hold, any passive investment strategy is going to yield 0 return. That would be strike three. In retirement, you cannot afford 10 to 15 years of flat returns.
So if you have questions about any of that, you want to learn more about how all this pertains to you and your situation, because Brian and Arrin always have to talk generally, right? They're not talking about specific clients of theirs. So your situation is unique. Maybe all of this makes perfect sense to you and you're like, I'm already doing that. Or I've not heard of that. I need to learn more about that. How would that help us? Maybe with our retirement. 833-707-3030 is the number. Again, no cost for this. 833-707-3030. Great opportunity for you to get some clarity into your retirement picture and your portfolio and how it's set up. 833-707-3030. And I could tell by what Brian was saying, he's headed to 2022, only the third time in history, stocks and bonds down in the same calendar year, 1931, 1969, 2022. Back with more of Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Back with our final segment in 1 minute.
Maximizing your deductions is like finding hidden treasures in the tax code. Let's navigate the financial landscape together. Call Brian Decker at 833-707-3030 for guidance.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Again, you can go to DeckerRetirementPlanning.com to learn more about the team if you would like. A lot of great information there. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. You can always find out a lot more because there's a lot of things you can download that are really just there for your information. So DeckerRetirementPlanning.com under the heading of Safer Retirement Education. I think one of the best is just get Brian's book. The Decker Approach book is right there as well. You can download that, read it, take your time. Then you got questions, call them. 833-707-3030. 833-707-3030. All right, Brian, you guys are down to your final 10 minutes. Where are you going to go to wrap this all up?
I'm going to hit the most recent downturn. That's 2022. In 90 seconds, cover what happened. In 2022, S&P is down 19%, NASDAQ down 33%, bonds down 20%. Commodities were down, and our principal guaranteed accounts, buckets 1, 2, and 3, made money. Our risk bucket, using momentum strategies, we have focused on the only sector of the market that went up during 2008. So that would be energy. Energy meaning the frackers, the drillers, the natural gas companies, the crude oil companies, the pipeline companies. Those managers made over 15 to 20% in those accounts. Now, our accounts were able to make money, not a lot. I think we made just under 1%, but we were one of the few clients, few retirement planning firms in the country that were able to make money for their clients in 2022. The reason we bring up these years is it's a good litmus test to run your plan, your retirement plan, through these years, 2000, 01, 02, 08, 2015, 2018, 2020, the COVID pandemic, and 2022. If you're having to change your retirement plans dramatically, that is not a plan for you. If you're looking for a plan that goes through these periods with spades, then we hope that we see you soon in our office and we can do some of your planning. Arrin, let me toss it back to you. Here we have declining interest rates. What should people be doing right now? What's the environment? What are some of the things that they should be focusing on?
Yep, this is one thing that we have been hitting really hard with both the prospects and the clients that we're working with now is that it's very, very likely that the Fed rate starts to come down this next month. So in less than a month from now, Fed could start to reduce interest rates. And as that happens, the principal guaranteed account options are also impacted. So things, just think about CDs, right? When it was 2020, you could walk down to the bank, you get a 1-year CD, and it was 0.1 or 0.2% interest, almost not even worth locking up the money for that period of time. Now you can get a CD for 5+%. And that isn't going to stay forever. So as they start to reduce rates, those rates in CDs, money markets, other principal guaranteed options also start to go down. So where we know we're theoretically at a peak interest rate wise now is a really good time to put those principal guaranteed accounts, our buckets 1 through 5, into place, because it will allow you to lock in those higher interest rates that will carry you through as those rates start to go down and as theoretically those markets start to have that flat market cycle. You're able to make money with those principal guaranteed accounts when a stock-based portion of your portfolio may have a slower time period. So again, we are doing a lot with our clients to be able to put these accounts into place and replace also underperforming assets. So I have a lot of people that come in and say, hey, I have this annuity, I have this CD, I have this XYZ investment. Is there anything better that we could do with this? And almost all of the time, we are able to get a better performing investment than what is currently in place. And so for those that don't have anything in place, for those that do and are looking to upgrade, now is a great time to be able to do that as we're at a peak from a Fed rate standpoint, and those rates are going to decrease here in the near future and then continuing on the next couple of years from now. So
Arrin, I want to compare what you're talking about to mortgage rates. When you had a 5 or 6% mortgage rate, rates went down to 3. What did you do? You refinanced it. So is this something similar?
Yeah, absolutely. So this is a way to be able to still have protection with those vehicles, but get paid more for doing that. It would be like you had a CD that's paying you 1% and now they're paying 5. Obviously, you're going to want to trade out the lower one, get into the higher one, earn that higher rate of interest and get that locked in for when the rates start to decrease here in the near future. So that's one of the points I'd like to drive home. And then the second one is just making sure that you manage the money that you have properly over the time that markets are going to be in flux. Obviously, we're all aware markets go up, markets go down. There's going to be movements. How long those up or down movements are, nobody really knows. If we go into a flat market cycle here and you don't really make money in stock-based investments over the course of an 8 or 10 or 15-year period, you need to think about how that's going to impact you. Are you going to be okay? Are you going to be able to have the income that you're looking for? Is your portfolio going to be able to weather that storm? So the principal guaranteed accounts are a key part of being able to do that. But the other part is being able to manage the money properly over time. So briefly touching on the 2021, I've actually had clients that came in for 2022 and for 2020 where they were managing the funds themselves or had another advisor that just kind of did whatever they told them to. And they sold out at the bottom of those troughs. They were down 20%, 30%, sold out, and then didn't really get any of the recovery of that in the COVID, in the 2022 dip. And they've missed out on 20, 30, 40% gains because they didn't understand how to properly manage the money. And so financial planning, retirement planning is as much about math and finance as it is about the emotional, just the thought process of managing it properly over time. You never want to sell at the bottom and then just sit on the sidelines. And so that's another value add that we provide here at Decker, is making sure that when there are those difficult market time periods, not only are you invested in the proper strategies, the proper investment vehicles, but you also have our support here to help you remember the important things during those time periods, that you are properly invested, that you don't need to pull all the money out and go sit into cash to miss out on those recoveries. You want to make sure not to make those silly mistakes that cost people serious amounts of money and serious amounts of income later over time. So anything you'd add to that, Brian, before I continue?
No, keep going.
The other things to consider here are just the time period of your life. So we've talked about in the radio show in multiple episodes, the difference between your accumulation years where you're focused on building up the assets versus your distribution years where the focus is more on protection, some growth, but also using the money as income. So a lot of times people are thinking, yay, the rates are going to go down. That's going to make mortgages cheaper. It's going to make car loans cheaper. It's going to make other lending things cheaper. And that may be good in certain circumstances, but for the retiree community that we serve, you want to make sure to take advantage of those high rates while we have them and be able to protect yourself when the rates start to go down. Because again, that tends to drive things like market recessions and corrections. It reduces the options that you have to be able to take advantage of those principal guaranteed accounts. And not always true, but it can also push inflation a little bit higher. So if we go back to having 5, 6, 7, 8% inflation like we had a couple of years ago, again, are you going to be protected in that circumstance based off the way that your portfolio is set up? So overall, we want to highlight here how those principal guaranteed accounts protect you in those difficult market periods. We've talked through the early 2000s, 2008, 2018, 2020, 2022, and those big market drops, 20, 30, 40%, typically happen about every 7 to 10 years. And so it's very likely that you'll have at least a couple more of those market drops in your retirement years. And you want to make sure that you're protected from those. The proper planning, the proper investment vehicles, the proper strategies, the proper approach overall with our holistic retirement planning approach will provide you with the protection needed to be able to weather those storms, be able to provide the income that you need, and to be able to provide you with that peace of mind that you need. So we'd love a chance to be able to sit down with you, talk through those things, help you understand how that can apply to your specific situation, and really give you that peace of mind that we provide for all of our clients.
And it's really easy to do. All you have to do is pick up the phone, call the team at Decker Retirement. It's 833-707-3030. Again, there is no cost for this. This might be one of the more important phone calls you make, and it's not going to cost you anything, but you're certainly going to get clarity into your retirement picture, your portfolio. Is it set up the right way for you and your situation? 833-707-3030. No cost, no obligation, no pressure, no judgment. 833-707-3030. Thanks for being with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Enjoy the rest of the weekend. Have a great week. And Brian will be back with more Safer Retirement Radio next week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.